It begins quietly, not with a crash or a collapse, but with a pause, the kind that stretches too long, where something invisible stops moving and no one quite knows why. In New York, the silence is financial. For months, the city's pulse, its banks, brokers, and real estate firms, has slowed to a near standstill. The skyscrapers still gleam, the subways still run, the trading floors still hum. But beneath the surface, the circulation of money, the one thing keeping this giant organism alive, has started to seize up. The liquidity has vanished. Every boom in American history has ended with too much confidence and too little cash. The same pattern is unfolding again. Banks that once poured billions into speculative towers in Hudson Yards or downtown condos are suddenly hoarding their reserves. The free-flowing credit that built luxury skyscrapers and fueled Wall Street's lending machines is evaporating. In the heart of Manhattan, at the corner of 42nd and Madison, a young analyst watches the daily flow of suits passing through the revolving doors of a J.P. Morgan Chase branch. To most, it looks like business as usual. To him, it feels staged, like actors in a play performing a financial system that no longer works. Inside those glass towers, liquidity models flash red. Repo desks, once flooded with cheap overnight loans, are running dry. Even the largest financial institutions, from J.P. Morgan to Wells Fargo and Bank of America, are sitting on mountains of assets they can't move. Real estate loans, commercial bonds, and securities backed by office buildings are frozen, unsellable. When rates were near zero, everything moved. Developers borrowed to build. Families borrowed to buy. Corporations borrowed to grow. Now, after years of aggressive tightening, the entire ecosystem is choking on its own debt. The liquidity trap isn't about having no money. It's about having money that's too scared to move. The Federal Reserve's strategy to cool inflation has cooled everything else. Interest rates at 5.5% have turned every dollar into a prisoner. The banks can't lend without losing. The developers can't borrow without collapsing. The investors can't sell without destroying their own balance sheets. Across Manhattan, construction cranes stand motionless, skeletons of ambition left hanging over half-finished towers. Developers who once bragged about billion-dollar valuations now whisper about restructuring. Funds that bought luxury buildings with cheap debt are trying to unload them at half the price, but no one is buying. This is how liquidity disappears, slowly, then all at once. Even in the trading rooms of Wall Street, traders have begun to notice it, the eerie calm between transactions. Mortgage-backed securities are barely moving. The secondary markets for commercial loans have shrunk. The appetite for risk has vanished. On a cold morning in October, Bloomberg flashes a headline: Regional bank liquidity stress rises to post-2020 high. It's not just a headline, it's a diagnosis. Small and mid-sized banks across America are facing the same paralysis. Their deposits are bleeding out as clients chase higher yields in money market funds. Their loan books are toxic, filled with commercial real estate debt from empty office towers and struggling landlords. The FDIC has already intervened quietly in several institutions. None of it makes the evening news, but the pressure is building. The liquidity trap is invisible until it's too late. It doesn't look like panic, it looks like stillness. In Midtown, luxury apartments sit dark at night, entire floors unsold or quietly abandoned by investors from abroad. Office towers once valued at $800 million are now appraised at half that. Pension funds and real estate investment trusts hold paper worth billions, but no buyer will touch it unless it's discounted by 60%. And yet, the system must pretend the prices are real. Because if they admit the losses, the collateral chain breaks. Banks have stopped marking their portfolios to market. The losses exist, but only on paper. The liquidity problem is a confidence problem. Everyone knows the assets are overvalued, but no one dares to price them honestly. It's a slow-motion credit freeze, one that starts in spreadsheets and ends in layoffs. Downtown, in a WeWork lobby that still smells like espresso and ambition, a startup founder stares at his bank app. His credit line, once $1 million, has been cut to $250,000 overnight. Risk management, his banker says. The founder shrugs, but he knows what that means. Payroll might not make it this month. Across the city, thousands of small businesses are feeling the same squeeze. From restaurants to logistics firms, the easy money that kept them alive after the pandemic has dried up. And yet the big banks are untouched, at least for now. JP Morgan posts record profits. Wells Fargo announces a new share buyback. Citigroup quietly exits commercial real estate exposure in several regions. The illusion of control remains intact until it isn't. Because even the biggest banks rely on confidence, and confidence is the first casualty of a liquidity trap. When the markets realize that liquidity is gone, the reaction is not chaos, it's paralysis. Investors stop buying, banks stop lending, and governments stop pretending. That's when the dominoes begin to tilt. On the 48th floor of a midtown tower, a risk manager watches the screens glow with data that makes no sense. Repo rates are rising. Overnight lending has slowed. Treasury yields are inverted again. And yet the official reports still speak of soft landings and moderate disinflation. He knows better. Liquidity doesn't lie. The dollar might be strong, but inside the system it's trapped, like blood that can't circulate, like oxygen cut off from the brain. Every delayed payment, every frozen deal, every cancelled project is another heartbeat missed. America's financial system isn't collapsing, it's suffocating. And while most people won't feel it immediately, the effects are starting to show. Apartment vacancies rise, rents fall, layoffs quietly return, banks trim credit lines, developers vanish. It's not a crash, it's a stall. The analyst at 42nd, and Madison walks past a billboard flashing, "Confidence in America's markets remains strong." He smiles faintly. He's read the liquidity reports. He's seen the internal memos. He knows the truth. The markets are holding their breath. Because once money stops moving in New York, it stops moving everywhere. By the winter of 2025, the symptoms are unmistakable. Something deep inside the American financial system has stopped functioning. A system designed to move trillions of dollars every day has begun to seize like a machine running out of oil. In the elegant glass towers of Lower Manhattan, the traders still show up. The screens still flash. The numbers still change. But everyone knows what's really happening. The money isn't moving the way it should. Liquidity, the invisible lifeblood of capitalism, has turned to ice. Every signal is flashing red. The interbank lending market is shrinking. The commercial paper market has thinned to its weakest level in years. Overnight repo loans that once cost fractions of a percent now demand rates no one wants to pay. It's not panic yet, but it's fear. Quiet, rational, corrosive fear. The crisis has a rhythm to it. First, hesitation, then hoarding, then paralysis. At Goldman Sachs, risk desks run simulations 20 hours a day. The reports are blunt. Liquidity coverage ratios are slipping, collateral values are unreliable, and the so-called safe assets, US Treasuries, are behaving in strange ways. The very instruments meant to anchor global finance are now part of the instability. Behind closed doors, meetings stretch past midnight. The phrase, "no one wants to say," systemic risk, begins to circulate again. It's not that banks are insolvent, it's that no one believes each other's numbers anymore. Every balance sheet looks like fiction. Office towers booked at $400 million are worth half that, maybe less. Bonds rated AA last year are now whisper traded at junk levels. Hedge funds mark their portfolios quietly downward. Private equity firms delay quarterly reports. The illusion of liquidity remains intact only because no one dares to test it. And in that silence, in that collective act of pretending, the economy starts to suffocate. Small regional banks, already weakened by deposit outflows, begin to fold under the weight of unrealized losses. 1, then 2, then 5. The FDIC steps in on a Friday night, just as it always does, and assures the public that the banking system remains sound. But this time, the message doesn't land. Because this time, it's not about a few reckless lenders, it's about structure itself. The liquidity trap has spread beyond finance into everything: real estate, labor, even the government's own fiscal mechanisms. Treasury auctions show weaker demand. Corporations delay bond issuance. Investors hoard cash. Money is everywhere, yet nowhere useful. Across New York, the effects ripple outward. Landlords can't refinance. Tenants can't renew. Mortgage rates have frozen transactions. Housing agents, once busy flipping deals, now spend their days scrolling through listings that never move. At the corner of Lexington and 58th, a for-lease sign hangs over a once crowded cafe. Closed indefinitely, it reads. But everyone knows the truth. The owner's credit line evaporated when his bank pulled back. In Soho, entire blocks of retail space sit dark, papered over with "coming soon" signs that have been there for a year. Even the ultra-wealthy are feeling it. Their portfolios, bloated with illiquid real estate and private credit, are suddenly worth less. On paper for now. The Hamptons mansions still shine, but offers are rare, and cash buyers are ghosts. For the first time in decades, wealth itself is trapped. At the Federal Reserve in Washington, officials study the numbers with growing unease. The models say one thing: liquidity injections would reignite inflation. But the markets are freezing, and if they don't move, the economy dies. It's a choice between two poisons: inflation or deflation, movement or paralysis. The Fed chooses silence, hoping the markets will self-correct, but the markets no longer believe in self-correction. They've seen too much debt, too many soft landings that never landed, and so the liquidity trap deepens. Wall Street begins to turn inward. JP Morgan expands its internal repo programs, lending to select partners under quiet terms. Citigroup quietly halts lending to new real estate funds. Morgan Stanley freezes margin extensions. Each firm, protecting itself, unknowingly makes the system weaker. Liquidity dies from isolation, every player hoarding what they have, waiting for someone else to make the first move. By January, the data is public. Credit creation has fallen to its lowest level since the 2008 crisis. The housing market is functionally frozen. Transactions down, construction halted, and inventory building up. The rental market is collapsing under its own weight as corporate landlords race to liquidate. And through it all, the average American sees only fragments: a job offer rescinded, a loan denied, a temporary delay in construction. But in New York, the signs are everywhere. In the financial district, scaffolding covers half-finished towers. On Wall Street, traders whisper about the squeeze. At night, the lights of the city reflect off darkened offices, billions of dollars of capital sitting idle. The liquidity trap has turned America's financial engine into a sculpture, beautiful, imposing, and completely still. Then comes the spark. In February, a mid-sized investment firm, leveraged into commercial mortgage-backed securities, fails to meet margin calls. Its lenders, a consortium of private credit funds, liquidate assets at a discount. The market barely notices. But a week later, two hedge funds with exposure to the same securities follow. Their liquidation hits a critical threshold. Overnight, pricing models for commercial debt adjust downward across the system. That's when the first domino tips. Regional banks holding those same securities suddenly find themselves undercapitalized. Investors pull deposits. The banks rush to the Fed's discount window, seeking emergency liquidity. But there's a limit. The Fed won't rescue everyone. credit spreads widen, Treasury yields spike, the dollar strengthens briefly, a sign of fear. And on a quiet Thursday morning, the New York Stock Exchange opens to an eerie calm. No crash, no panic, just absence. Volume evaporates. Algorithms shut down. The market isn't falling, it's freezing. The liquidity trap has reached its final stage, systemic paralysis. The entire structure of global finance, built on the assumption that money can move freely, is now a network of frozen promises. And in that moment, America faces the truth it's been avoiding for years. It's not a shortage of wealth that ends empires. It's when wealth stops moving. The Federal Reserve convenes an emergency meeting. The Treasury Secretary calls the heads of the major banks. Overnight lending windows reopen quietly under new terms. Trillions are prepared to be injected, but confidence, once lost, isn't something that can be printed. On Wall Street, traders watch the screens flicker, knowing the playbook is being rewritten again, just like 2008, just like 2020. But this time, the enemy isn't panic. It's inertia. Outside, in the quiet streets of Manhattan, snow drifts between the towers. The lights of the financial district shimmer against the clouds. Inside those buildings, billions of dollars in liquidity sit still, waiting for someone to believe again. The trap has closed. The question now is simple. Who will move first?